What if you think a stock is going up, but you don't want to spend a fortune buying call options? A bull call spread is one of the most popular beginner option strategies because it reduces cost, reduces risk, and still allows you to profit if the stock rises. But there's a catch. Your profit is capped. Welcome to Valkyrie Simple Finance. In this video, we'll show you exactly how bull call spreads work in simple terms. A bull call spread is created using two call options. First, you buy a call option. Second, you sell another call option at a higher strike price. Both options will usually have the same expiry date. The strategy is bullish, meaning you believe the stock will rise, but probably not explode upwards. So why sell the second call option? Well, buying a call option alone can be expensive. So instead of paying the full cost, you sell another call option to reduce the price of that trade. The premium you receive from selling the second call option helps offset the cost of the first call option. That makes the strategy cheaper than simply buying a call option outright. Let's use a simple example. XYZ stock is trading at $100. So you buy a 100 strike call for $8. And you also sell a 110 strike call for $3. Your total cost is $5 per share. That's the $8 you pay for the 100 strike call minus the $3 you receive for the 110 strike call. Since one option contract usually controls 100 stocks, your total risk, your total outlay is $500. Now, if the stock rises, your purchase call option gains value, but your sold call option also starts losing value. The spread profits from the difference between the two strike prices. The ideal outcome is for the stock to rise to the higher strike price by the expiry date. Now, your maximum profit is limited, so you can calculate it using the difference between the two strike prices minus the amount you paid for the spread. In this example, the difference between the two strike prices is 10 and you paid 5. So the maximum profit is also $5 per share, or $500 in total. Now your maximum loss is also simple. It's the amount you paid to enter the trade. The $8 you paid for the 100 strike call minus the $3 you received for the 110 strike call. So we're talking $5. If the stock stays below the lower strike price, both options will expire worthless, and you will have lost your $5 per share. So the break-even point is the lower strike price plus the net cost of the spread. So in this example, the stock must rise above $105 before the trade becomes profitable. A bull call spread works best when you expect a moderate rise in the stock price, but not a huge explosive rally. So in our example, you want the stock to rise between 105 and 110. That's where you expect the best outcome. This strategy is popular because it lowers costs and it reduces risk. But the trade-off is limited upside. So compared to buying a single call option, a bull call spread lowers the cost, has lower risk, and requires less outlay. But your profit is capped and you won't benefit from a massive rally in the stock. So in summary, a bull call spread is one of the most practical beginner option strategies. You buy one call option, you sell another call option at a higher strike price, so reduce your costs, and you profit if the stock rises moderately. It's simple, defined risk, and far less dangerous than many advanced option strategies. But remember, options trading still involves risk, and beginners should always understand their maximum loss before entering any trade. Thank you for watching. If this video helped simplify bull call spreads, subscribe to Valkyrie Simple Finance for more beginner-friendly investing and options education. I look forward to seeing you on the next video.